Hello, in the last video, we introduced the financial planning and analysis process and the master budget as the central part of the FP&A module for the planning purpose. This time, let's examine two related budget examples in the book. One is regarding a music event organizer, and the other one is a related manufacturer company for the event chairs. The first example is the music event organizer, so we can use this as a service or non-manufacturer industry. So the budgets for this company is unique because the music event occurs only in the third quarter of the year, but the preparation of the event starts from the beginning of the year, such as the advertising, promotions, and also like the event organizations. And in the fourth quarter, there is basically nothing happened. So most of the budgeting work are done for the first 3 quarters. So will involve sales budgets and all of the supporting expenses and the purchase budget for the music event. And most of the budgets we introduced in this service case can be extended to a merchandiser or a manufacturer budgets as well, because they mostly share the same framework, but with adjustment for the unique needs from the other two industries. So in this video, we'll focus on the music event organizing budget. And I'm trying to mark, so when you read the SMART book, I'm trying to make some notes and highlight some of the key concepts I want you to pay attention when you read and interact with the readings. I think I'm the instructor for the course. So if I mark something or make these instructor notes, when you read the book, you should be able to see the different notes, so notations I made for the reading part. For example, this one I use a highlight, and if you see the dotted line and click on it, so I made some instructor notes related to additional explanation or something I want you to pay attention. And you even can require like a reading a lot parts or for the whole chapter, or you can select a few paragraphs. When you work on something else, you just want to hear the text rather than reading it. So there are other formats of going through the information. So let's go through. So they have some background introduction of the music events and the company's background. After the company invited another partner to like the original, like the musical partner for the company, the new partner introduced the FP&A to help them to organize the business into a formal planning and analysis process. And the budget making will be an essential part of the FP&A process. So the new partner introduced the benefits. So what they can do to use the master budget, because the original partner is kind of concerned about the cost and also the time they need to spend on preparing the budget. So this is really linked to the 5 purposes or the benefits we talk about in the intro parts. So what a master budget can do for any organization. So you can do lots of planning, so the CVP analysis can be part of the planning purpose, right? So you are planning for the activity levels, like the sales activities or service activities. Then all of the expenses needed to be incurred to support the revenue generations. And what are the best ways to reach the business goals, right, for the target profit So if we have multiple options, what are the best options for us to achieve the business goals? And then by constructing the master budget, we can communicate the management, right? So communicate it to all of the functions, departments, and the personnel regarding the comprehensive plan. So everyone will be kept updated. So because most things are driven by the sales, then what we need to do for the other functions to support and make the sales happen. And where we are going to get the resources to conduct the business activities and how to allocate the resources efficiently to different functions, and monitoring and controlling during the process of the activities and make necessary adjustments as needed. And finally, evaluate the performance. So after you close the loop, evaluating the performance, and so we can improve the planning for the next budgeting cycle. Okay, and also for performance evaluations like this related to the bonus or benefits. Okay, that's kind of tied into the employee incentives. So let's start it with the number of the sequence and the numbering of the budgets needed in this event organizing and related to the budget type we talk about in the intro parts. We'll have the sales budget at the starting point, and then the operational budget, like the direct cost expenses, activities to support the sales. And then we have the financial plans, like, so how these operational budgets will bring cash flow into the business, and how we are going to pay out of pocket for the expenses and the cost. Okay, even for like equipment purchase or some asset purchase. So the operational data will be converted to the cash receipt budget, cash disbursement budget, and a overall cash budget. 6, 7, and 8 are internal budget planning for the cash sufficiencies, not the cash flow statement we offer to the external users. And eventually you can collect the related information to make the predicted income statement and also the predicted cash flow statement. They ignore the balance sheet in this case because for this service, it's not really a consistent like a day-to-day operations as a regular merchandiser, service, or manufacture industry. So probably you dismiss all of the remaining assets, right? All the cash before you start another budgeting cycle. So the balance sheet is not a concern or focus for this budgeting case. But in the next manufacturer example, we'll bring the balance sheet into the budgeting system. For sales budget is very critical, so the accuracy and the timely information for the sales volume and the sales pricing all needed to make the sales budget. And this is not really a job can be done by the accounting or finance people, right? So it's majorly by the managers, like the marketing managers or even the top level managers. And in this case, is related to the musical partner, right? So really they know about the industry. They can make a reasonable and reliable estimate about the ticket sales and the consumers coming for the events, and also the merch sales related to the events. So in here, we are assuming we already have the sales forecast and the ticket sales spread into the first 3 quarters. So as we mentioned, the first quarter is really a nothing. Okay, so the whole budgeting period is actually happened only for the first, second, and the third quarter, the first 9 months. In first quarter and the second quarter, we pre-sale the ticket. And in the first quarter, you have also in the second quarter, we have discounted sales price, so 100 per ticket. And you have an estimate for 10,000 ticket sales. So you may have direct sales, you all may be having the sales agent, right? So ticket agent to sell the tickets. In that case, we need to pay some commissions or some cost related to the sales of the tickets. And then in the quarter of the event, we get back to the regular pricing for the tickets, but you have less ticket sales in the quarter of the event. So you have the sales revenue spread in the 3 quarters, but keep in mind, these are not really the cash revenues or cash receipts, because you may give like credit terms. Okay, you may say for ticket sale, normally it's a one-time, credit card or cash transaction, but it's case by case. So later when you're trying to prepare the cash receipt budget, you need to combine the sales budget with your credit policies. I believe in our music case, they allow 25% down pay and then 75% collected in the next quarter. Okay, that's kind of the case. We examine the cash receipt later before the cash budget. And in third quarter, we have also the special merchandise sale for the event t-shirts. Okay, that's only for the third quarter. You have estimation for the sales volume, and with the estimation of the guests buying the merch. Okay, so not all of the guests will buy the merch, so 20%. So 5,000 t-shirts sale with the pricing for the t-shirts. So we have a revenue estimate for the 3 quarters. Oh, this is the most straightforward. Then imagine you have a whole store of inventory like merchandising stores or manufacturing industries, or you will end up with multiple hundreds or thousands of different products and services. Okay, this is kind of a simple case we start. And the annual total, okay, for the sales forecast. And then to support the sales budget, so what kind of purchasing and expense activities? We need to buy the t-shirts. You don't make the t-shirts by yourself, right? You want to find a vendor to make the t-shirts, and so we can get it. And also you have other supporting, like all of the expenses to invite the band, right? So the cost to invite the music groups, and also technicians and admin staff. I don't know, they can be, like temporary employees, right? So it's an event organizer, is not an ongoing business. So it's case by case, okay, to see the cost, the expenses, like labor, all what we need to support the sales activities. So we have a budget for the purchasing activities only, like majorly your t-shirts. And this is the budgeting for the t-shirts, because the t-shirts sale only for the third quarter. And we have, you can see all the music, not only the t-shirts. Okay, we also have the music purchase related to the band. So the payment to the band we invited to the third quarter, okay, in addition to the t-shirts purchase. So you have an average, okay, like different, like the primary players and additional band in the event. So we have different pricing for the primary band, the headliner band, and some other bands. And you definitely pay much higher for the 3 headliners and lower payment for the other, with the minor bands we invited to the event. So musical purchases. And then the t-shirt purchase, remember we have the estimation for the 5,000 units, and the estimated vendor cost is $15. You sell it at 35 and the cost is 15. So those are the total purchasing costs related to the third quarter for the events and the merch. And how much cash we need for all of these payments. Okay, so you will see those information later in the cash disbursement budget. Some of them you may put on account. So it means like the band, you may pay half of the contract on the spot, right? And then put the other half later. So it again is case by case. How we translate the sales budget or purchasing budget into the cash budgets is depending on the sales term and the purchasing term with the different vendors. But this is the cost for the third quarter. This information we also need them in the income statement, like the cost for the sales. Then the direct labor budget. You may want to consider separate the purchase, labor, and other supporting like overhead type of cost. You don't want to put them together, so make the budgets too much complicated to follow. So direct labor budgets involve the people we hired, either on like how long. You may have some labor hired for the whole 3 quarters, like the admin stuff or preparation of the events. And then you have some labors only hired for like, the guest services during the music event. But anyway, I highlighted with the labor cost will compromise the different personnels as required, such as the technicians, guest logistic staff, and the musician supporting staff. That's really industry specific labors. You need to make a adequate planning for the different type of talent and also the hours they need to work. And you can see most of the labor costs that they put in, for the direct labor cost, they put in for the third quarter only. So the festival hours and then the technician, attendees, guest logistic, and also the musician support stuff all happened in the third quarter. So we end up almost $72,000 for direct labor cost. Be careful, direct labor cost. Even this is a different, not really a actual manufacturer setting. We also use the direct labor, right? So direct cost, indirect cost. So direct labor means they are the labor directly support our activity, like activity cost driver, right? So activity is the music events, and these are the labor costs that directly serve the musical events. And then we have the production overhead and other SG&A, sales, general, and admin expenses budget. The production overhead is not a manufacturer production, is a musical or event production, so involving your supporting or indirect overhead expenses. And in this case, so we have the costs spread to the prior 2 quarters. So you have some supporting labor costs incurred from the second quarter, like supervisors. And rental, right? So like the rental activities. Then we have the production overhead cost, the ticket is sold. You can see the commission, right? Or like the So related to the ticket sales and the purchasing and the general supplies, we also incurred from the very first quarter, second quarter, and the third quarter. Even in the first quarter, we have some general supply purchasings. Liability insurance, which is absolutely needed, right? So for kind of the safety and some other insurance purpose, and the total allocated production. Remember, I think we had one time in NRG Park, right? So it's a disaster. I forgot, it's a couple of years ago. Like they're too much crowded, so the event organizer didn't expect or didn't really put enough, right? So they're too crowded, so you like step it, and so it caused the death and injuries to the guests to the events. Oh, that's very bad. So that's like make sure you have enough insurance coverage in case something bad. Even not really people injury, and then maybe some other accidents. And then total allocated overhead. So supporting overhead and SG&A expense. This is overhead only, not as SG&As yet. And also you can see most of the supporting costs also incurred in the third quarter. Okay, so like it's really uneven, okay, because that's related to the one time, because the rental of the audio, festival grants, and other utilities, right? So securities maintenance, that's all in the third quarter. And then your selling, general, and admin expense budget is also started from the beginning. Event advertising, right? So sales and marketing support. You put in different venues and you hire people, maybe like consulting people for all of these activities. And so it's end up you got another 200 or 220,000 expenses. Again, in here, for the SG&A, we especially take out the non-cash SG&A expenses, mostly the depreciation in related. So we also have the cash payments information, but the labor overhead, we didn't really put how much cash you need to pay out of these items. Those information we'll put in the cash budget, so it's a cash disbursement. But only the SG&A, we already identified the non-cash expense. So you got the total expense will be used in the income statement because the accrual basis. In accounting, we use the accrual basis to recognize revenues and expenses, but they are not really your cash revenue and cash expenses. And now, after all of the operational budgets, we convert them into the cash receipt budgets, cash disbursement budget, and the overall cash budget. They are called the financing budgets. The cash receipt, in our case, majorly coming from the sales budget with your credit policies. Okay, I put the explanation because of the, so this one should be made based upon the sales budgets and adjusted for your credit policies. In our case, they specify 25% of the ticket sale will be collected in the first quarter, and 100% of the ticket sales in all other quarters. Okay, you only allow for credit payments, like you postpone payments for the first quarter ticket sales. Second and the third is one-time payment. So that's giving you this cash. So be very careful when you make the cash receipt. we need to convert the sales revenue with the credit policies. So for the first quarter sales, the $1 million, you see they only get a cash 25% of this one. So if I can highlight. So this is 25% of first quarter sale, and then other 75% you got it in the second quarter. And this is only for the first quarter ticket sale. Okay, so when you read it, and the second quarter, third quarter, all of their ticket sale will be collected as the full amount of cash, so no delay. And then that constitute your total cash receipt for the 3 quarters. Also in the third quarter, we have the t-shirts sale, given consideration of the uncollectible accounts. I just wonder why. I think the t-shirt sale is on the spot sale, right, with credit card or cash payments, but they still estimated a 2.5% of bad debt, okay, like from schedule. But again, this is case by case. You need to estimate your uncollectible accounts receivable or bad debt. Okay, for me, I don't really think this is a one-time merge sale. It's not on wholesale, or you consistently have the account receivables. But anyway, they put a deduction for uncollectible, okay, from the t-shirt sales. We got a discounted cash. But the t-shirt sale plus the ticket sales cash receipt. So again, actually you see most of the cash come in the second quarter, right? And so on really even, okay, the third quarter and then the first quarter, we have about like 3 million cash receipt, okay, for the whole budgeting period. And here they explain more details about this credit policy, how the credit policies can play a role in the different budgeting, like the quarters. And sometimes if the credit policy involve 3 quarters, or like first quarter, second, and the third, that's making the schedule more complex. So when you do the calculations, you need to be very careful about the cash disbursement, okay, like the cash distribution among the months or the quarters involved. And then the cash disbursement. So cash disbursement, we have several schedules related to the cash payments. We have the purchasing budget, the direct labor budgets, production overhead, and SG&As. So how the payment of the cash will be scheduled for these expenses and the cost is depending on your vendor contract and your payment terms. Okay, so again, accounting is the costs and expenses are on the accrual basis. Okay, as long as they incurred, they recognize them as expense and we put them in the income statement. But they do not necessarily represent the cash payment on the spot. Okay, there may be delayed payments or payment on accounts. So given these considerations, let's take a look for the payments of the vendors, the music bands, and other expenses. So you can see here, we for the music, like the purchasing budget, the music purchase, like the band, you can see we pay in the second quarter, or it's like a prepayment, right? Then you pay the other half during the event. And all the secondary bands you pay on the spot, the total amount. And then the t-shirts we pay is like a prepayment, like a down payment in the second quarter, and the rest on the third quarter when the t-shirts were delivered to the event. So that's related to your purchase. So music band, the headliners, secondary, and your t-shirt purchase. Those are coming from your purchase budget. And the other cash disbursement, labor, all paid in the third quarter from the direct labors. Production overhead from Schedule 4, okay, you pay according to, so well, kind of like, this case, we simplified. We are assuming all of the cash payments made in the same quarter when the overhead incurred. So it's the same thing as your overhead budget. But SG&A is deducting the non-cash depreciation. So be careful when you transfer from Schedule 5. You need to put the cash expense, okay, not the original SG&A. And you got the total cash payments, and you can see $2.7 million. Okay, or like I'm just saying approximately. And you have your cash, total cash receipts. Now we bring them together, okay, to see our overall cash sufficiency picture for the whole budgeting period. So each quarter we're starting from zero, like that's I'm saying. So making a balance sheet is really irrelevant in this case. Is like we start over, right? So you don't really have carrying asset balances from past, from the past period. So we start from zero cash, and then the cash receipts minus the total cash payments. And the third, we have a total cash change. We like changing cash balance for the third quarter. The first two quarters are positive because we don't have many expenses or like cash payments. But the third quarter, you can see we have a negative, like a negative. The receipts is less than the disbursement. Okay, so yes, disbursement. So you got like a negative change in cash balance, but that's fine because we have cash accumulation from the first two quarters. So you still end up okay, like positive. And I think we are assuming we have some financing activities. Okay, you put the extra balance of your cash into the bank, especially the second quarter, into maybe some saving accounts or like a 3 months CD. So we can earn some additional interest revenue for the first three quarters. So interest revenue, they give you an example for how to figure out the average cash balance and also the rate of return on the investment, like assuming a 1.25% quarterly interest rate. And they are making the beginning, so they have the calculation, for example, the second quarter, you have the beginning cash balance and plus half of the change in cash balance. Okay, that's like and this is not, for this music, they use this formula, but for your own company, you can use your own average cash balance calculation to figure out because this is a budget, not really actual transactions. We are making the best prediction. So you are flexible to use whatever the quantitative method, to come up with your calculations. So let me put a note. So this is the example. I know because this is the image, I cannot really mark this, but this is an example for the second quarter. So it's this one. So you can see the calculation below. For the interest revenue. So this one, 9,341, where you can get it. This is the example calculation. Similarly, we can do the one for the third quarter, but you got some extra interest revenue. And then in the fourth quarter, we have a negative, okay, because we have no more revenues, no more cash receipts, but you do have some cash payments, okay, in that. But overall, we got a positive, cash balance to $87,976. And be careful, this is only your cash balance, not really the net income or profit we earned. But in this case, pretty much this number should be very close to the net income because we don't have lots of those carry over or carry forward issues. Okay, even you have this like on smooth the cash receipts and the cash payments. But overall for the year, this is kind of your operating results or in terms of the cash balance. Or this is the financial outcome of the cash term. And now let's see the two budgeted financial statements, the income statement and the cash flow statement. The income statement is based upon the accrual basis. Be careful, this is not the cash, so it is coming from your original operational schedule. And your sales revenue budgets, the total numbers only, and your purchase budget, okay, cost of purchase, direct labors, and then production overhead, we have the gross margin. Oh, this is not a manufacturer type of gross margin. It's like a service or event gross margin. And then we minus the supporting expenses from your SG&A and the bad debt expense. But interest income is additional revenue or secondary revenue. So your operating items and then supporting items. We have a pre-tax income. Be careful. 257 is kind of lower, right? Almost 30,000 less than the cash balance. I will give you a reason. So think about why. Yeah, I give you a question to think. So why? Like overall, right? So 1 year closed. So why the net income is less than the cash balance by about 30,000? So what the major reason bring the difference? So I will keep it an open question to think about it, and I can talk about it next time. And then suppose, right, not really suppose, you need to pay income tax, or 35 approximate, and you finally end up a after-tax profit. So 167,000. And this income tax you need to pay out of your pocket, so cash. Okay, so like if this one 90,000 need to be deducted from your cash balance, okay, so your cash balance will be reduced to about 200 as well. Okay, so like because of the income tax. And finally, the statement of cash flow, which is the presentation of our cash change over the budgeting period, but for external users. Okay, so it is disclosed to your investors or to the IRS and some external stakeholders. So this is not a repeating of the cash budget we made for internal management. So we are converting or representing the cash information using the direct method for cash flow. So we are telling the users the cash flow, how much cash flow we generated from the operating activities, which is the event, like an event organizing, right? So the music event. And in this unique case, I think all of the cash flows coming from the operating activities. We don't have investment on equipment or long-term investments. We don't have borrowing or stock issue like those other financing activities. But if you do a regular merchandiser manufacturer industry, they do have those two type of cash flows. So we can evaluate and so how reasonable the cash flow. Okay, the distribution of the cash items among the three categories. A healthy company, you should get most of the cash flow from your operating activities. And again, so that's like you are reorganizing this using your cash information. Okay, cash item. So cash sales, interest cash, then cash spent on purchasing, cash spent on direct labor, overhead cash, and then SG&A expenses cash. And the cash balance here should match with the balance we have in the budget or in the cash budget. But again, like this is the budgeted financial statement doesn't include the balance sheet in this case because this is a 1 year event. They don't really carrying over cash or other type of assets. But we can pick up the balance sheet budget in the related manufacturer example. Okay, but for this case, you can check all of these summaries. So do we have some assumptions? We have predictions. So not everything is 100% accurate. And so what do we need to pay attention and how we can remind people when they read the budgets. So what they need to pay attention on all of these issues. So I will stop here for this like kind of one-time event budgets, and let's pick the manufacturer budget next time. Okay, for when we try to expand the budgets to include the production budget, inventory budgets, cost of goods manufactured, cost of goods sold, and then the balance sheet.